installment of the Financial Literacy Series. I'm Professor Howard Askew. Today, just a little housekeeping things. Please make sure you sign in if you haven't already signed in, and there are some handouts that we'll be using today, so grab a hold of those. Also, there's lunch available for you. If you are a student, make sure that you tell me who your instructor is so that I can get that email to them. If you are faculty or staff and you're here for Flex, your Flex number is 96208. But make sure that you register by midnight tonight or you won't get credit, it will disappear. So what we're going to talk about today is investments. You are very fortunate to have Paul Lim here to talk about investments. But I also want to let you know that this series is underwritten by our friends back at Cal Coast. So if you have any questions, just make sure you stop and see them today. The Mesa Foundation, and also San Diego Financial Literacy Center, which is a great organization, one of the organizations that Paul actually volunteers for. So I will give the floor to Paul.
Thank you, Professor Askew. All right. Good afternoon, everybody. It's almost afternoon. My name is Paul Lim. I'm a certified financial planner professional. I'm with LPL Financial. Our company's called the Wealth Consulting Group. Today, I want to talk with you a little bit about investments. And I will start really just by saying that my commentary as far as the financial industry is concerned is that there is a tendency to overcomplicate things. And I dislike that aspect of it because it intimidates people into not taking the action that they should. And really, my purpose is to clarify, demystify a lot of the concepts that are obfuscated in order to help you have the confidence to at least begin to take those baby steps that are necessary in order to achieve financial success. And investments are going to be a very important component of achieving financial success in the future. I would assert to you that virtually everybody here is going to need to talk about investments at some point in their lives. And by the way, I don't mean just stocks. We could be talking about real estate, we could be talking about business interests, we could be talking about anything out there that is in that particular realm. The real reason for that is because of the fact that inflation causes the prices of goods and services to increase over time, probably by about 4% or so. And so if your savings are not earning at least that much, you are actually losing purchasing power over time. So as the money supply grows, you need to ensure that your savings are earning at least a certain amount in order to make it such that by the time you are done working, you have just as much in terms of purchasing power as you did when you put the money away in the first place. So let me give you an example. Prices will double about every 18 years. So if I'm 30 years old and I want to retire at 66, well, that means that prices are going to quadruple by the time that I need to retire. And so during that time, I need to put my money away by diligently saving into various types of accounts, and then invest in a manner that is prudent so that during good years in the market, I will participate in those gains, but during bad years in the market, I will be able to not realize the entirety of those losses or at least mitigate those when they occur. So that's going to be really the purpose of today's discussion, and we're going to go through each of these items together. Now, the main theme I want to leave you with, if you don't remember anything else from this particular discussion, is that diversification is key. Anytime that we have uncertainty in life, one of the best ways to address it is through the principle of diversification. And this will do a number of things for you. It spreads out risk. And this is a way to make it such that the way in which you participate in the market is not like gambling. So I've had many people come to me and they say, well, I'm very uncomfortable utilizing stock market investments. I've never done it before. I'm not a big gambler, and I don't like that aspect of things. And you can make investing into gambling if you do it in the wrong way. But if you approach it with the right principles, with the right philosophy, and then you implement time-tested methods, you can actually make it so that it's not like gambling at all. So I'll give you some things to think about. The most professional gamblers that are out there, the ones who make all the money, the ones that are top in their performance as far as World Series of Poker or whatever else you want to talk about, they have about a 55-45 win-loss ratio. That's very lean. I was surprised when I came to find some of that. But they only win about 5% more of the time than they lose. So the pro gamblers that are out there only have about a 55-45 win-loss ratio. That is very surprising, I think, to hear some of that. When you utilize stock market investments, you don't have anything close to that level of uncertainty, because if you do it in the prudent way that we're going to discuss in a moment, you're making a very reasonable bet. You're not betting that my combination of 5 cards that I have is going to be more rare than everybody else than me at the table. I'm not betting that my white ball is going to land in the particular square that I anticipate, and therefore I'm going to guess out of a set of numbers. You're betting that the value of the largest companies in the United States right now is going to be worth more by the time I'm done working than they are at the current moment. That is not really an unreasonable bet if you think about it. Imagine that you're going to be working for the next 36 years or so, and all of the employees who work at Apple and Google and Microsoft and Caterpillar, I had to pick a non-technology company. Imagine they're all going to go to work, and they're getting better and better at what they do. They're trying to figure out new and improved ways to deliver products and services. They're going to hire new, energetic talent. They're going to fire all the worst people who weren't good at their jobs. And that happens for the next 36 years. Do you think those companies are going to be worth more by the time you quit working than they are right now? Would we say that's a fairly safe assumption? Okay, that is the bet you are making when you utilize stock market investments. If you think about that, that's like, I'd be more surprised if that didn't happen, if anything else. So if you can look at investments in that way, then it becomes a totally different way in which to approach investments themselves. So that kind of gives some context. Make sense so far? All right, good. Let's talk a little bit about the principle of diversification. And I will start this just by mentioning to you that there is no perfect investment. There is no investment out there that is better than all the others. They all have trade-offs. They all have advantages and disadvantages. And so I'm going to give you kind of a metaphor that I think is very useful in terms of being able to figure out ways to evaluate efficacy of the different investments that are out there. So here's an example. Okay. So our metaphor goes, there's only 8 ounces of juice in an orange, and there's only 4 glasses in which you can pour that juice. And so let's go through each one of these glasses. S is for safety. Safety means that if I put something into this type of instrument, I'm not going to lose value, or I'm not going to lose very much value. I think we all kind of understand the safety portion of items. So first glass is safety. C is for cash flow, something that's going to pay me an income stream on a regular basis. So let's say real estate is a good example. Rental real estate. I buy this property, the mortgage costs me this much, and I'm going to charge the person to live there this much more, so that way they can pay off my loan, and then whatever the difference is, I get to pocket that as income. That's pretty nice, because it's like a golden goose that just sends you eggs over and over again. That's cash flow, right? So it's going to give you a little income stream, and it never stops over time. That's cash flow. A is for appreciation. It means that you're going to buy something here and it's going to grow to become something up here. So it's going to be worth more over time. So if I buy a stock of a company and in 36 years when I'm done working, it's worth more than it was when I bought it, that's appreciation. And I bought it here, I sell it up here. Pretty straightforward. T is for tax benefits. Sometimes there are some investments out there that will allow me to save money on income taxes, capital gains taxes, etc. Sometimes there are investments that will pay me cash flow that are not subject to income tax. Say municipal bonds, for example. So that's a good example of a T kind of investment. So basically, those are for public works projects. If a company wants to build, if a municipality, if a town or a government wants to build a road or a bridge, something of that nature, they need to raise money from the public. And in order to incent that kind of investment, the interest that they pay to those bond investors is not subject to income tax. So that's an example. Now, if I take my 8 ounces of juice and I pour it all into the safety bucket, I'm not going to get any cash flow. It's not going to grow that much. It's not going to appreciate. And I'm not going to get very good tax benefits. If I put all of my money in the appreciation bucket and I pour all the juice into the appreciation glass, well, it's not going to be very safe. I'm not going to get any cash flow on it. And it might be really taxable when I sell it later. So if I do that, that's not necessarily the best way to go either. If I end up making it so that I only pour 2 ounces of juice in every glass, well, fine, I'm going to have all those benefits, but it's not going to do any one of those things particularly well. So it just goes to show you that there is no perfect investment. Every single one of them is going to have some combo of these characteristics, and you've only got 8 ounces with which to work. So that is kind of the way that we're going to approach how investments operate from an efficiency perspective. So what do we do if we know that there is no perfect investment? Where do I put all my money if they're all going to have various trade-offs? You buy all of them. You diversify. You make it so that you put some of your money in investments that have a lot of safety. You put some of your money in investments that have a lot of appreciation. But just in case that doesn't go according to plan, I'm going to have some of it that's going to give me some cash flow. I'm going to put some over there. I think you all understand what I mean when I say that we diversify in order to take advantage of all these characteristics and that we shouldn't put all our eggs in one basket, right? Okay. Let's take this lesson and apply it more specifically to some real-world investments. So let's take a look at this first example over here. All right, so this colored chart, when you take a look at it, is going to show you different asset types in the US, in the stock market as a whole. Each one of these colored squares represents a different asset category. And they've ranked them from best performance to worst performance. So the best performers are at the top, worst performers are at the bottom, and it's like the last 20 years or so. Now, the tendency for most individual investors is to look back in time and say, well, what's doing well recently? Well, whatever's doing well, I want to buy that. That's not the way to go because you'll end up setting yourself up for a trend reversal. So let's pretend we were in the year 2000, for example. If I were to look back in time, I'd see these blue large cap growth stocks doing very well. And you'd say, wow, 38%, 33%. That's very good. I want to put my money there. If you purchased those, you'll notice that in the next 3 years, they did very badly. Negative 22, negative 20, negative 28. And then the worst color back in 1999, which was this green bond square, fixed income, it did the best from 2000 to 2002. So if you were in the year 2000 and you had looked back in time to try to figure out what would be the best place to go going forward, you would have made exactly the wrong decision. And it would have been a total reversal and you would have been very discouraged if that occurred. Let's look at 2008. If I were to look back in time from 2008, I see these light blue international stocks doing really well. And you'd say, I want to buy those. Those look good. They've been doing great for the last 5 years. But then it does negative 43% in 2008. You'd be discouraged and you'd say, I don't want to buy those anymore. That was horrible. And then the next year it did positive 31. So if you followed your instincts too much and you looked at past results and tried to outsmart everybody and simply extrapolated past results going forward, you would have made exactly the wrong decisions. And that's what too many people do. Yes?
So you manually have to go in throughout the years and change it yourself, change what you're trying to invest in?
Almost. We're going to get to what you should do in just a moment. The tendency would be, though, to try and guess what's going to be the top performer next year. Instead, what we should say to ourselves, in light of this uncertainty, is to diversify. And so you say to yourself, I have no idea what's going to do best next year. So I'm going to buy the entire world. And if something out there is doing well, I own it in my portfolio. But if something out there is crashing, at least I don't have all my money in that part of the world. That concept is called the diversified portfolio. So you'll notice on the chart, the orange square. Do you see the diversified portfolio here? This owns a little bit of every single color. So what you'll notice about the diversified portfolio is it's never the best, it's never the worst, it's a little more consistent over time. This is how you want to treat the money that you're going to use to feed and clothe yourself when you're not working anymore. And so being able to say to yourself that I'm not going to try and be overly clever, I'm not going to try and outguess all the people who are out there trying to forecast all day and night while I'm at my job doing what I know how to do. You should instead just say, I don't have to worry about what's going to do well because I've properly diversified. I have put my assets amongst all categories. And then that way, I'm not going to beat myself up if I don't do the best. But I also know that because I own a little bit of everything, I can't possibly do the worst, right? So by definition, the diversified portfolio is the prudent bet that I had mentioned to you in the beginning. If you do it in this way, the bet you are making when investing in the stock market is night and day compared to gambling at the casino. Because all you are asserting, all you are counting on, is that the value of these assets that I purchased today, which is really ownership in large companies, is going to be worth more in the future than it is right now at this moment. That is a pretty safe assumption if you think about it. If not, we all have big problems. So that is an example of what I mean by diversifying with investments. So then what do we do with this information? I've given you all a risk quiz. So this investment risk quiz is an example of how to figure out where you fall in terms of comfort level when it comes to investment risk. Because some people don't mind if their account moves up and down a lot. They'll say, I have a long-term perspective on this. I'm not going to worry about what happens in the day-to-day. All I'm worried about is what it's worth at the time that I retire, which is a long time from now, so I'm not worried about it. There are some people who cannot stand to see their portfolio go down by even a little bit because it's emotionally distressing to them. There is no right answer. It's about whatever makes you feel comfortable. And so this survey seeks to determine that for you. Fill out the answers to the quiz, you'll score up your points, and it will tell you whether or not you're a very aggressive investor or a very conservative investor. These are 5 different versions of that orange square that I gave you before. You can have a conservative version of the orange square, you can have an aggressive version of the orange square. And the only difference between them is this. An aggressive investment is going to have really high highs and very low lows. So here's 0% rate of return. It could go up this much, or it could go down this much. A conservative investment might be more like this. Might go up a little, might go down a little. And that's it. And you just pick the one that's closest to you. There is no right answer. It's just determining what makes sense for the way that you feel about investment risk. Then what I've done here is I've given you an example of what any financial company can provide in terms of a recommendation. So If, for example, you were to score an aggressive growth on your survey, here's a list of all the different types of funds you should own. And these are the percents that you should allocate to each of those funds. If instead you score very conservative, well, these are the percents that you should own instead. And these are the names of the funds that you should own. So this gives you a very practical way to implement that philosophy that I shared with you, which is the diversified portfolio. And then that's it. That's as complicated as you need to make it. And you should instead focus your mental energy on going to work, becoming better and better at your job so that you'll get pay raises. And then when you get pay raises, you will be very conscientious and you won't expand your lifestyle. What you're going to do is you're going to ramp up your savings, or you're going to increase your lifestyle and your savings proportionally. And what you'll do is you'll have more dollars to put away, more dollars to save. You're going to continuously buy more and more shares of the diversified portfolio. And then that way, you go to work doing what you do best, and you don't spend/waste your time trying to outsmart people in an exercise that's not worthwhile anyway, really, if you think about it. I know that it's very tempting, especially when trying to discuss and talk with peers at cocktail parties or family reunions or whatever it is, and people don't want to hear this. This is very boring to talk about with other people, where you just say, oh, I just buy the major indices, I put away the money and I buy and hold. That's very boring at a cocktail party. That's not what people want to hear. They want to hear, well, I did all this research and I bought this bond, I sold it up here, and then Jim Cramer said this on TV, and so I went and I pushed the button, I made a bunch of money. That is what people want to hear, but that is not the way to go. It's possible that you may get a couple of wins during that time, but as often as you're right, you might be wrong. When you speak with relatives and peers about it, you'll never hear about the failures. You're only going to hear about the times that they did really well. And sometimes the people that talk the loudest know the least, surprisingly. So instead, if you can eliminate some of that and not worry too much about being more clever or overly clever, and you simply utilize time-tested, repeatable, replicatable strategy, that's going to give you much more peace of mind, but also success over the long term. Does that make sense as far as investment strategy is concerned? Okay, now let's dig a little deeper and go more detail. And I'm going to give you some examples as to categories, and we can kind of expand on our metaphor a little bit more. So here's some categories of assets. So there's something called a large cap stock, and you all know what this is. These are big companies that are well established. And what you're going to notice about large cap investments is that they're going to be fairly stable. They're going to have a lot of juice in the safety glass, for example. You can look at it and say, well, I'm pretty sure that Pepsi is not going to go out of business tomorrow. But at the same time, how much bigger can Pepsi really get? They're kind of everywhere. I don't think anybody doesn't know who Pepsi is. They're kind of in every country. How much better can they get? They've tried every flavor that's out there. What else are they going to do in order to grow a lot higher? There's going to be some safety in buying a stock like that, but not a whole lot of appreciation. So you'd see a lot here, not so much here, as an example. And there's something called a small cap stock. So with a small cap stock, these might be names you've never heard of before. And they could go out of business. But if they do well, maybe they become the next Google. And if you want to participate in a company that appreciates rapidly in value, you want to buy them when they're small. Why would you buy them after the growth has already happened, right? You need to buy them when they're low so that during the ride upwards, you benefit from that appreciation. I think everybody understands that. So on this side of the equation, we have maybe not so much juice in the safety glass, but a lot more juice in the appreciation glass, as an example. And then you'll have something called mid-cap stocks. This is just in between the two. So if you understand small and large, you'll understand medium. So those are three different kinds of stocks that you'll want to own. Here's another asset category that we'll want to learn. International stocks. So you don't want to own just United States stocks. United States does pretty well, but they don't always do well. And maybe during a year when US stock markets are not doing so well, maybe there's another country out there that does very well. And so if you own those international stocks, although your US holdings might go down a little bit, your non-US holdings might go up a little bit. And then those gains will help to offset some of the losses you occurred on this side. That is diversification in action. So that's another asset category you want to include. Everybody can understand why you want to own some non-US stocks, right? All right. Then you're going to have bonds. Bond is another type of investment that are out there. I think what we should do is just talk very briefly about what a bond is, and then I'll give you some examples of why you'd want to diversify amongst bonds as well, and that'll give you kind of an idea of what I mean by diversification in addition to that. So, what is a bond? A bond is a promise. A bond is a promise to borrow money from you and pay you back over time. So let me give an example. You've all gone to the bank and borrowed money, for example. Maybe you've gone to a credit union in San Diego and gotten a very good rate because their customer service is excellent and they give you good terms. And one of the things they'll look at when you want to have a loan is they'll say, how much money do you want to borrow? And you'll tell them, I want to borrow $10,000. And they'll look at your credit history and they'll see, does this person pay on time? Does this person cause me to charge off debts? Do they run away from their obligations? Have they committed bankruptcy or declared bankruptcy rather? If any of those things occur, that doesn't bode well. And I look at some of those statistics and I would say, the likelihood that this person is going to be conscientious enough to pay me back and on time is fairly low. So in order to compensate for that risk, I need to charge them a higher interest rate. On the other hand, if you see that they always pay on time, they never have charges off of bad debts or anything of that nature, they never default, well, then you can probably give that person a very compelling interest rate because of the fact that it's very likely, based on their past behavior, that they're going to honor their obligation and pay back the bank, for example. So that is something to think about. And you have a certain amount of payments and you pay them back over a certain period of time. We've all experienced that. When you own a bond, you are the bank. In essence, what you get to do is you take your $1,000, because every bond comes in $1,000 denominations. Every single promise is $1,000 a piece. And so you have your $1,000 and you say, let me think about this. To whom should I lend this money? I'm going to give this borrower $1,000, and then the borrower is going to pay me interest payments over time, and at the end of the term of the promise, they're going to pay me back. So I'll give you an example of the most famous bond that's out there. It's the 10-year Treasury bond, right? And so let's pretend that I give the US government $1,000. I give them one promise. And the US government is going to promise to pay me 3% for the next 10 years. So 3% times 1,000 is $30, of course. So they're going to pay me $30, $30, $30. They're going to do that 10 years in a row. And at the end of the 10 years, they give me back my $1,000. Now, that's going to be the lowest rate that you're going to find on most of these bonds because the US government is extremely creditworthy. They are the most creditworthy borrower on the planet. They are not going to default on you. They will pay you back. Even if they don't have the money lying around, they can just print new money and then give you that to pay you back. So you're not going to have any real risk as far as this bond is concerned. So this type of bond, you're going to have a lot in the safety glass, and you're going to have a little bit in the cash flow glass, for example. Let's compare this to a different kind of bond. Let's pretend I have a startup company, and it's a 3-year promise. And you're going to look at this here and say, why would I give money to a startup company? I've never heard of your product before. What if you go out of business and you can't pay me back my money? I mean, that's a probable event, right? If some company goes out of business and they can't pay you back because there's no money, what happens to your $1,000? It's gone, right? But how could they compel you to give them money. Well, what if they paid you 9%? You might look at that and you say, oh, that's a different story. And so maybe what they do is they give you a 3-year promise at 9%. So every year they'll give you $90, $90, $90. They do that 3 times in a row, and at the end of the time they give you back your 1,000. And you look at that, you might say, well, that's a much higher rate, and what's the probability that they're going to go out of business in 3 years? Maybe in 10 years that could happen, but 3 years, maybe I'll take that bet, right? That might be compelling enough. If it's not compelling, maybe they need to pay 10%, something else like that. But you can understand why, at a certain point, a less creditworthy borrower could still get people to give them money, right? Okay, so that is an example. This kind of a bond is going to have more here, but less juice here. Make sense so far? So which one's better? What do we do? Which one of those should I buy? Well, remember, if we have uncertainty, we diversify, right? So you buy both. You buy both, just in case. You never know what will happen. That is an example of how you'd want to diversify. You don't want to own just large cap stock. You don't want to own just small cap stock. You buy both. You buy all of them. That is the principle of the orange square. Make sense so far? Okay, good. Saw a question before. Do you have a question?
Yes, so if a startup company is doing both stock and bond, would you recommend to do the stock or to do the bond?
You can do both, right? If you don't know which one's better, they're all going to have different characteristics. The stock is going to have different allocations of juice, so to speak, than the bond. And you're looking at this and you say, well, which one's better? There's no way to know which one's better unless you knew the future. So you do both, right? So that's an example of it. So that just goes more to the principle of diversification. So those are some examples of ways that we can figure out the types of investments that are out there. Okay. So if we look more at the safety bucket, people have asked before, like, oh, how do I get started? What do I do? Well, first thing you should do is establish a cash reserve for yourself. And this is defined as 3 to 6 months worth of your living expenses. So if you can be yourself on $4,000 a month, for example, you'll need something between $12,000 to $24,000 as a cash cushion before you really should invest. And there's a good reason as to why. The cash reserve savings is a good exercise to see if you're capable of saving. If you start to build up a savings account, you get $2,000 in there, but emergencies happen, and then you take it out and you have to spend it on something, and then you build it up again to $3,000, you have to pull it out and spend it on something, or maybe you're just compulsive. Maybe you're just a spender, that kind of a thing. It's better to know that ahead of time than to put your money into an account that maybe you can't touch until you're 59 and a half years old and pay taxes and penalties when you have to withdraw it early. So cash reserve gives you the ability to deal with life's emergencies. Life is just strange, and those things happen. So we have to plan for them. We can't just say, oh, I'm never going to have tragedies happen in my life. You just have to put that money away first. And then, once you meet that emergency fund, now you have extra money above and beyond that you can put into some investment instruments. And because you're very conscientious and you don't live paycheck to paycheck, you are going to have an extra amount at the end of each month to put away. And so that is the first step in terms of approaching your investments. I say this all the time. Be brilliant at the basics. You need to be able to spend less than what you earn. That's hard enough as it is. It's hard enough to just show up and not get fired and make ends meet. I understand that's a difficult thing. And being able to spend less than that and to be humble enough to know that you shouldn't live beyond your means is simple but not easy. We say that all the time. Simple but not easy. But that's really where you should be placing your mental energy. Focus on that first so that you can have the means to build up the savings you need in order to begin doing some of this. So again, cash cushion first, then you can begin investing. Then we have to ask ourselves, okay, well, should I put my money into an account that's going to be for the long term, like a retirement account at my work? That's usually a good place to start because you'll get tax deductions for making those contributions, and we reviewed that last time in the tax class. Sometimes you get a match from your employer, so they'll double up your money when you put it in there. And anything that gets you excited about saving is a good thing, in my opinion. So in that example, you'll have tax benefits. You'll get appreciation in an account like that because of the fact that you'll get some matching from your employer. And then, of course, you'll allocate those dollars in a diversified way because you've embraced the principle that we talked about before. Maybe you're going to have another investment account that's a non-retirement account. And the nice part about the non-retirement account is you can touch it before you're 59 and a half years old. So if I want to save up for a new house or a wedding or junior's college fund or whatever it is, that might be a good place to put dollars that you can access before you're 59 and a half. Now what's going to happen there is you're not really going to have as much juice in the tax-free bucket, but you'll be able to access it much quicker, and some of the dividends will come out to you as well, and you can receive them, and so maybe there's a little bit in the cash flow bucket. And so when we talk about diversification, we're not just talking about the type of investment that we have, but we can also talk about the accounts in which we save. So people have asked before, should I have a Roth IRA? Should I have a traditional IRA? Which one's better? Neither one's better. They serve different purposes. You should have both. Maybe you should have both. Maybe you shouldn't have both. It depends on your circumstance. But the process of determining which strategies are applicable to you and your best course of action, that's the whole process of financial planning. That's what that is being able to determine what those are. But before you can do any kind of planning, you need to take care of the basics at home first. And that all starts with spending less than what you earn and having a job, keeping a job, and then being good at your job so you're not paid the same thing over and over again for the next 10 years while prices are going up, right? So those are important things to think about. All right, that's a lot of the main content I wanted to go through, but I know that people probably have some questions and they want to kind of bring this more into real life. Why don't we just start and see what kind of things people want to talk about in addition, anything else that's on your mind that you want to go through. Yes?
Have you heard of Acorn?
Yes.
What do you think about that?
So that's an interesting application, and if that can get you excited about saving, then I think it's a good thing. If it can get you to be excited and to have some ownership of putting dollars away, it's a good tool, right? So it's a method. It's just a tool. The principle you have to keep in mind is voluntarily saving. That program basically rounds up your transactions to the nearest dollar, and it just basically puts pennies away. And I think it's free for college students, so if that's something that you want to utilize, that can be a great way to at least begin. Now, as your needs get a little more sophisticated, you might outgrow that particular platform, but that's a good way to begin. So yeah, I think that I would say that it's a good thing to at least begin.
That, based on how the market's going, it invests for you? It changes the company's?
Yeah, I mean, it basically gives you a portfolio that is diversified in and of itself, but they'll ask you some questions to kind of figure out which of their models makes the most sense, and they're basically crowdsourcing lots of pennies together, and so for them it adds up. And you get the ability to utilize some investments that maybe you couldn't before because you don't meet the minimums and that kind of a thing. So it's a great way to get your foot in the door. But it's not an end-all be-all solution. You are eventually going to have to save much more than pennies per month. It's never going to work. Right? You're going to need to at some point aggressively say, I'm choosing to put away several $100s, several $1,000s away per month in order to get to the goal you need to. It's a great place to begin, but it's not the end-all be-all.
So does it go off of, it takes out $75 at the first of every month as well?
Okay, so there's a fee. That's their fee for it if you're not a college student, is that?
Oh, no, that's what I put out.
Oh, okay, cool, got it.
To invest
good.
So that also, does it take the whole quantity of everything that's in there and invests into?
Yeah, okay, so if you're making that voluntary contribution of 75, that's excellent. That's great, because you really are making a deliberate choice to do that. I know that their main feature is just to round up transactions and things of that nature, which is still a good thing because it's barely
I
noticeable.
think if you're not a student, it's $1 a month.
That's not that bad.
So.
That's pretty good. So great place to get started, great tool to utilize, especially if it gets you engaged in the process. Yep, so great question, thank you. All right, so why don't we talk a little bit more about ways in which to achieve the diversified portfolio. Maybe that'll prompt some additional questions that are over here. So when we talk about how to begin with a small amount of money, like you might have to begin with using Acorns or something like that, it becomes difficult to own the diversified portfolio with a small amount of money. Remember that one bond is $1,000. One share of Google is probably $1,000. So if I want to own the 500 biggest companies that are in the United States in order to copy this portion of my portfolio, I'm going to need to start off with a lot of money. And so how am I going to have a lot of money when I need the diversified portfolio to get there, but I can't buy the diversified portfolio with a lot of money, so it becomes a very interesting conundrum over here. So these products came out, they're called mutual funds. So in case you've ever heard about something like this, let's kind of explain what this is. So a mutual fund is basically a manager that crowdsources investments from lots of different people. And so people choose to put away their dollars together and give them all to a mutual fund manager. And then the mutual fund manager, when they have lots of money with which to work, they buy thousands of bonds and stocks in their portfolio. And all of the investors in the fund get shares of the fund. And the shares derive their value from the performance of the portfolio itself. And so it gives you a very practical way to diversify your money starting off with a small amount. Some minimum initial investments are like $250. You can buy a share of a mutual fund with $250. Some are $1,000, but even that's not that bad, right? So that's an example of a practical way to own the diversified portfolio right away. Now, there are tons of mutual funds that are out there, a lot of them. There are some mutual funds that specialize in buying things like this. There are some mutual funds that specialize in buying small cap stocks, for example. But there are some mutual funds out there that specialize in providing the diversified portfolio. Sometimes you'll see the word balanced in the name. Sometimes it will say asset allocation fund or something of that nature. Sometimes it'll say moderate portfolio. Sometimes it'll say aggressive portfolio in the name of the fund. That's usually a giveaway that it's a diversified portfolio and it's meant to be one holding in and of itself. So you don't need to own 5 different funds. You can own one fund that's diversified in and of itself. There are some funds that are out there that you'll probably see in your retirement plan. So for example, if you go to your job and you don't know where to start and you would rather not look through all the lists of the mutual funds and some of them are not so obvious. Sometimes a mutual fund will say, this is a large cap fund. Well, I can probably guess what that fund does. But sometimes it's not so obvious. It'll be some very odd name. It'll be like Ariel or like Wellington. It's like, what is a Wellington? So those are examples of sometimes the name's not so obvious. But virtually every retirement plan that's out there is now mandated by law to have these things called target date funds. So I'll give you an example. It'll be like the American Century 2045 fund, for example. Or there's the 2060 fund, for example. If you ever see names like that after the name of the mutual fund, that's a target date mutual fund. And the whole idea is that you invest in the fund that is closest to your retirement date or your goal date or whatever it is. If Junior is going to go to college in 17 years, maybe I buy the 2035 fund. It's the one that's closest to your goal, the closest one to the time at which you need said money. And the whole idea is that the fund is diversified in and of itself, but it changes every single year so that as you approach that target date, it gets more and more conservative. So it's aggressive in the beginning. The 2060 fund right now, that's going to be very aggressive because that's going to be for somebody who's not going to retire for the next 42 years. So you can afford to take a lot of risk during those times. But as you get closer and closer to retirement, you're not going to want to take as much risk. And you're going to want to really dial that back. And there's an important reason for that. If I have a portfolio of $5,000 and I go down by 10%, I've only lost $500, right? But if I have a portfolio that's $500,000 and I go down by 10%, that's $50,000. It's like a year's worth of work. That's a big deal. So you really need to dial back the risk as you approach your retirement date, but also as your account balances get larger. And so then it becomes very important to utilize maybe some more advanced strategies at that point in time. But again, you need to start first before you have that problem. That's a great problem to have, and that's maybe a point at which professional advice can really make a difference. But you need to start in order to have that problem later on, if that makes sense. Yes?
What happens to those target date mutual funds, like in 2045? Does it close out and you just get cash?
Oh, that's a great question. Yeah, by then they're probably owning lots of money market and cash, and maybe that's not where you want to park it forever, because even when you're retired, you are going to need to get a little bit of appreciation because prices are not going to stop going up just because you're done working, right? So
It still exists after that time frame?
it does. It does. It's probably going to be invested in a lot of income-producing instruments, so stuff that has a lot of juice in this glass and a lot of juice in this glass. Not very much here, because you should be ostensibly done appreciating at that point, kind of thing. Yeah. Yes?
So after, this might seem like a silly question, but just if you're first starting out investing, after you've built up your reserve fund, you're ready to start, you have $250, where do you go?
Sure. I think a great place to begin for most people is a retirement plan at work. And the reason why is because you can just set it up through payroll deduction, so it doesn't mean that you need to be conscientious every single month and say, oh, I just got paid, I got to put $125 in so that way I can meet my $250 a month. It just happens automatically for you. And it's out of sight, out of mind. You put it away, and it just happens without you knowing. Furthermore, if you do the pre-tax contribution, which we talked about in last class, you'll get a deduction for it. I know you understand what that means. So you'll get a tax deduction. So either your refund will be larger or you'll owe less at the end of the year, as an example, if you do that too. So it's two birds. Sometimes it's three birds, one stone, because you'll get a match from your employer, and they will double up your money that you put in or give you great appreciation on those dollars just for putting it in as well. So that is basically a three-facet objective as far as saving, and that can be a great place to begin, especially if you don't have anything else before. You'd be very surprised at how quickly that thing can add up. You'll look back after 3 years and you'll say, wow, I have several $1,000s. That's great. That's usually a good place to start.
And what if you're at a smaller company that doesn't have a very well-developed plan? Like my company's a boutique firm, so they're pretty small and just starting to develop. Like they just got healthcare for everyone. They just are developing their 401k and things like that.
Yep.
What if you're at a smaller?
So if you don't have one, if one is not provided to you, if one is not offered by your employer, you can always do what's called an IRA, individual retirement account. So not a retirement account through work, but an IRA. And so last time in the tax class we talked about the differences between a traditional IRA, where you will get tax deductions for putting in, versus a Roth IRA, where you don't get a tax deduction, but it's tax-free in the future. And that's a way to set up your own plan. You can still automate savings by just doing a voided check and saying, I want money to come out on the 2nd and the 16th of every month, kind of thing, because that's when I get paid, or the day after I get paid. And it's going to happen automatically. As soon as the paycheck hits my bank account, a little bit's going to go out for my future self. And you can just put that into an IRA. The differences are, you're not going to get a match. You will still get tax deductions. You still get the automation going. But the maximums are lower, so you can only put in 5,500 instead of 18,000 as an example. But that's a way for you to start your own retirement plan as a person. So you can't use the fact that your boutique firm doesn't offer a plan as an excuse not to get started. Right? And if they offer one later, you just join them then, that kind of thing. So that's kind of a good place to begin, to answer your question. Yes?
If you did start that way, you didn't really have access to a good plan, and then you got access to a good plan, you can roll it over into it, right?
You could, and there may or may not be reasons for doing that. So for example, in an IRA, you can buy whatever you want, pretty much, as long as you have the minimums to meet it. If you have to utilize your employer-sponsored plan, you're going to have a finite list of mutual funds. You can only get, most plans have 30 funds, maybe 40 funds at most. And those are all that you can choose. So you're going to be limited as far as what you can pick. Now, for most people, maybe that's all they need, right? But you're never going to be able to buy low-cost index fund, for example, in an employer plan. You can probably only get those in an IRA. You can't buy individual stocks. Not that I would recommend necessarily buying individual stocks unless you've done the basics first, kind of a thing, but at least you'd have the prerogative in an outside account, in an IRA, on your own. There is one big advantage that the employer plan will have over an IRA, and that's bankruptcy protection. So if you ever declare bankruptcy, the rules on 401k plans, for example, are much more robust than they would be in an IRA. IRA limits are still really high. I think it's like $1 million. Don't hold me on that, but it's much more generous if you put the money in there, for example. So that's kind of the only real big advantage I can think of as far as the 401k, because as great as the 401k is, and as great as it is to get that match and to have that happen automatically, the expenses internally for running a plan like that are very high. Because I mean, think of all the record keeping. I've got to have payroll, take this money out of a paycheck and put it in there, and then the mutual fund company has to calculate the rate of return, and then all of the employers and the bosses, they have to put the matching money in on time, and there's penalties if you don't do it. And so that's expensive. That adds up. And so it all comes out of the assets of the plan. All those expenses are usually just spread amongst all participants, because it's barely noticeable when you just spread it out amongst all employees, as opposed to the company writing a big check based on it every month. So you're going to save a lot in internal operating costs if you have your own IRA, because an IRA is not complex. It's just you. How much money did she put in? What funds did she buy? There's no matching. There's no compliance. You're not going to sue yourself. You're not going to defraud yourself, right? So there's none of that liability associated with the IRA. So those are all examples of reasons why it may or may not make sense to roll an IRA in or to keep it outside. Yes?
So what's the difference taking this amount of money out of your paycheck every month, putting in an IRA, or just having the different saving account like a CD and putting it over there? What's the benefit of it?
So if I save money into a CD, I'm not going to get a tax deduction, right? And a CD is going to appreciate a little bit, but I'm not going to get a return that will outpace inflation, as we talked about before. So by definition, no bank instrument is going to give me an amount that's higher than inflation, or else the bank is upside down on that. So again, there is a total reason to put money away into bank instruments. We have our cash reserve that we talked about before, and the bank instrument is going to have a lot in the safety glass, but just not very much here. The mutual fund or something that you'd buy inside of an IRA, it's going to have a little less juice here, but it's going to have more juice here, right? So which one's better? Neither one's better. You buy both. Does that answer your question?
Yeah, and then on IRA, if you want to use it toward down payment for the house or something, can you, or are you going to be locked also?
There are some limited circumstances in which you can pull dollars out of an IRA to fund a first-time home purchase, or if you have hardship or emergencies or things of that nature. There are some circumstances in which you can dodge a 10% penalty, but usually you still pay income tax if that money comes out. And again, they're limited as far as what you can do. An IRA is not a savings account. That's why you have a savings account for stuff that happens before 59 and a half. You should really view retirement accounts as long-term money. It's stuff that you're not planning to touch for a long, long time. So it should not be relied upon as a savings account or a reserve. But again, you can get there, and it's just slow, steady progress. You just take deliberate actions, and you make it so you're better today than you were yesterday. And that's all you have to really be concerned about. It's all a gradual process. But once you get started, every day gets easier.
Okay, listening to presentation that you have, and most of the thing that is good out of it is for long-term future. But what can help us for right now that we can, besides just sitting down making regular money, if you still have saving and using that to make another money?
Yeah, good question.
Okay.
So the type.
Right now make myself
Right.
comfortable, then just I'm thinking, okay, when I get 70, I'm gonna be comfortable.
Yeah. No, that's a
what I
good
came
question.
for.
Good question. Okay. So there's going to be a different kind of account you're going to want to utilize, a non-retirement account. Because anytime you have a retirement account, there's going to be all those rules on it. Oh, you can only put in this much, you have to be this old and take it out, or there's those penalties. There are accounts out there that are not designated for retirement. So the technical name for this is non-qualified account, non-qualified brokerage account. And this is money where put as much in as you want, take as much out as you want. There's no timing, there's no restrictions. You can do whatever you want with it. You can invest in whatever you want. The difference is the way that taxes are treated. So if I put money into something like this, I do not get a deduction. If I pull money out of the account, though, I'm only going to pay taxes if I make money on my money. So for example, if I bought a stock for $5,000 and I sell it for $3,000, I'm only going to pay taxes on $3,000. And it's usually capital gains taxes, which is a lower amount than regular income. So you're only going to pay taxes if you make money on your money. All your principal is tax-free. So that is an account that you can use for like a wedding fund, for example, or new home purchase, or new car, that kind of a thing. That is an account that you can use before you're 59 and a half because it's not designated for retirement. So that can be a good place to do it. Non-qualified brokerage account, that's the answer. Right.
What's the risk on these?
So the risk is going to be determined not by the account in which you hold the money. It's going to be determined by what you hold inside the account. So for example, I can buy stocks in this account, I can buy mutual funds in this account, and if I buy risky mutual funds, I'm going to have risk. If I buy extremely conservative mutual funds, I'm not going to have that much risk. So the wrapper, whether it's in a retirement account or a non-retirement account, that's going to determine your accessibility and the way that taxes work. But your risk is determined by what you choose to invest in more than anything else. What you choose to own inside the account determines the risk.
Do you have any suggestions?
You're going to hear this a lot, but it depends. It depends on each person. It depends on their goal. One of the things I'd have everybody do before I make any recommendation, I have you fill out the risk quiz that I passed out before.
No, I came late on that.
Oh, that's okay. It's all right. The risk quiz helps you determine whether or not you'll use very conservative investments or very aggressive investments. There's no right answer. It's just about whatever is in accordance with your sentiment, right? So that is the first step. And then you would ask more about the person's goals. You say, tell me what's most important for you to do in this time frame. And then, based on their answers, based on their responses, then you narrow down the top 2 or 3 ideas that'll make sense for them. And so that's the whole process of figuring that out. But I think that when we don't know which one's going to be better than the others, you diversify and you do all of them, right? So you'll have some money in short-term cash, you'll have some money in medium-term non-retirement money, and you'll have some long-term money. They all serve different purposes. You should own all of them. One's not better than the other because they all do different things. They all have trade-offs. They all have advantages, disadvantages. Okay? Good. All right. Anything else? Yes.
When a fund has an expense, does that expense come from your contribution, or does it come from your dividends and gains from the fund?
When you say expense, what do you mean specifically?
Like if I was to invest in a mutual fund that had a 2% expense ratio.
Oh, okay, I see. That's going to come out of your rate of return if you own a mutual fund with an expense ratio on it.
What if the mutual fund is negative?
Then it will exacerbate your loss.
Gotcha. Thank you.
Yes.
What would be the benefits or disadvantages of having a portfolio where you're like 50% is conservative, you're diversifying, and then the other 50% is high risk, high reward?
You can do that. That's certainly viable, especially if you're comfortable with that attitude. And that is diversifying. That is, you're embracing that principle. Some of my money is going to be safe, stable. So I'm going to own a lot of these kinds of things. But some of my money is going to really load up here. So I would encourage you to do something like that. Yeah. All right. Well, thank you, everybody, for participating. You've been a great audience today. I really appreciate you inviting me out.